Welcome to Group Insurance Daily Pulse, your rapid-fire download of the critical shifts impacting our sector. I'm Arya, the actuary, here to dissect the P&L implications and regulatory headwinds.
And I'm Dorian, the distribution expert, ready to spotlight the market opportunities and ROI drivers. Today, June 26, 2026, we're tracking three major developments that dropped in the last 48 hours. Let's dive in. First up, a significant leadership announcement from Aon plc. They've appointed Mike Pasterick as North America Health Leader, effective June 25, 2026. Pasterick will oversee Aon's health solutions operations across North America, reporting to Anne Corona, CEO of North America, and Byron Beebe, CEO of Human Capital. He takes over from Farheen Dam, now CEO of Enterprise Clients and Chief Client Officer. From a distribution standpoint, this signals Aon's doubled-down focus on the evolving healthcare and benefits landscape. We can anticipate strategic shifts influencing how Aon develops and delivers health and benefit solutions. For brokers, this means potential impacts on competitive offerings and client advisory. Employers should expect integrated strategies addressing complex health and benefits issues, new therapies, evolving employee well-being expectations, and the growing influence of technology. This is about leveraging Aon's full capabilities to drive innovation and enhance client value, ultimately bolstering market share and client retention.
Effective June 2026, Dorian. That's a full year out. My actuarial radar immediately flags the interim strategy. Furthermore, the transition on new therapies and changing employee well-being expectations directly translates to increased claims volatility and medical loss ratio, or MLR pressure for carriers. Aon will advise how to manage these accelerating cost drivers for their self-funded clients. What are the implications for stop-loss attachment points and aggregate deductibles? From a regulatory perspective, integrated strategies could invite increased scrutiny from departments of insurance regarding bundled service transparency, potential conflicts of interest, and adherence to state-specific benefit mandates. Will Aon push for bespoke plan designs that introduce administrative complexities and actuarial pricing friction for carrier partners, ultimately impacting carrier profitability and underwriting cycles? Solvency models must account for this increased complexity and potential for adverse selection if benefit design becomes overly customized without robust risk transfer mechanisms. The key is execution. The risk lies in the gap between strategic intent and operational reality. Moving on, Insurity, a leading cloud-based software provider, just dropped their Cassiopeia release on June 25, 2026. This is a game changer for operational efficiency. Cassiopeia introduces new capabilities designed to eliminate operational friction across underwriting, policy administration, premium audit, specialty operations, and financial workflows.
Key innovations include AI-guided decision support for accelerating underwriting decisions with real-time risk insights, enhanced real-time notifications for policy work, new multi-currency processing for global operations, and critical enhancements to sanction screening and HIPAA readiness for financial and compliance operations. This platform also significantly expands distribution opportunities through enhanced APIs and automated data sharing.
While eliminating operational friction is a laudable goal, Dorian, my immediate concern is the inherent model risk associated with AI-guided decision support for accelerating underwriting. What are the guardrails for bias detection and mitigation? We've seen regulatory bodies like state DOIs scrutinize AI algorithms for disparate impact, especially in underwriting. On compliance, while HIPAA readiness improvements are critical, the broader data privacy landscape, CCPA, various state-specific privacy laws, presents a more complex challenge. Does this truly ensure compliance, or merely provide capabilities that still require robust internal governance? The expanded APIs, while enhancing connectivity, simultaneously broaden the attack surface for cybersecurity threats. How are data security and integrity maintained across these new interfaces, particularly with the highly sensitive PHI involved in group health? Finally, multi-currency processing, while beneficial for global operations, adds complexity to financial reporting and regulatory capital requirements if not perfectly integrated and validated. Any miscalibration in AI or data integration could lead to adverse selection or claims leakage, directly impacting IBNR calculations, reserving adequacy, and ultimately carrier solvency. The promise of efficiency must be weighed against the embedded operational and regulatory risks. Our final headline today is a big one from the regulatory front. CMS finalized sweeping changes to the Affordable Care Act, ACA, health insurance marketplace through its 2027 Notice of Benefit and Payment Parameters final rule on June 25, 2026. This rule makes significant changes to marketplace enrollment, eligibility verification, special enrollment periods, catastrophic plans, and plan offerings, with implications for coverage levels, patient responsibility, and enrollment patterns. CMS has expanded access to catastrophic plans and revised enrollment and income verification requirements. This comes on the heels of the expiration of enhanced ACA subsidies, meaning millions of patients could face higher premium costs and reevaluate their health insurance options. For carriers, this presents both challenges and clear opportunities. Dorian, while you see opportunity, I see significant P&L pressure and solvency concerns radiating from the CMS final rule. Revised enrollment and income verification requirements introduce potential for increased administrative burden, or worse, eligibility fraud, which directly impacts claims costs and regulatory compliance. Healthcare organizations expecting changes in reimbursement, collections, bad debt, and payer mix will inevitably pass some of those costs on to carriers through negotiations, further pressuring carrier P&L. The indirect impact on employer benefit strategies is not merely an opportunity, it's a significant risk transfer. If employees migrate from the individual market to employer-sponsored plans due to affordability, group carriers must be prepared for a potential influx of higher-risk individuals, especially if those individuals were previously priced out of comprehensive individual plans. This necessitates a complete reevaluation of group underwriting strategies, rate stability models, and reserving adequacy. The volatility introduced by such fluid regulatory environments makes accurate pricing and capital management exceedingly difficult, posing a direct threat to carrier solvency. We are entering a period of significant market uncertainty and risk recalibration. A dense but critical 15 minutes. The regulatory landscape continues to reshape our risk calculus.
And the strategic moves and technological advancements demand our attention for market positioning and growth.
That's it for today's Group Insurance Daily Pulse.
Stay informed, stay agile. We'll be back tomorrow with more.